you know that working with any company, there's some challenges, and Mutual of Omaha, they certainly aren't perfect. They have their issues that we fight on your behalf on the administrative side of things. But all things considered, if you look at the stability of the company versus others, the features of their custom product, their rates, and actually the value in that product, we think they stand head and shoulders above the rest. There we go. That took 3 clicks. You know, we get quotes every day, many quotes from agents or requests for quotes. And usually what they're trying to do is just find the least expensive plan, as though all products are basically the same and the carriers are largely irrelevant. In fact, even some of our very best producers fall into this trap. They go onto our website, run our StratDecision program with a side-by-side quote, and they'll even screen share with their customers, showing them you know, several plans and showing them the low number. And I think StratDecision over the course of time has, I don't know, created, I think, some bad habits with agents. It used to be agents, I think, were a little bit more thoughtful in deciding which carrier, which product they wanted to present. No doubt price is really important, and the carriers have raised the rates where people can't afford the same coverage today that they could before. But for the most part, that's kind of in our head. That's in the agent's head, where we've been beat up over the years with rate increase after rate increase after rate increase. And I think in some cases we're now taking the path of least resistance, just trying to make a sale. But our job really is to find the right value. And as professionals, I think we have an obligation to really get under the hood and rummage around and really find which ones are the best value. And when I talk about value, I don't mean just value today, the lower sticker price today. We need to think about the long term with this business. We're talking about claims that aren't going to happen for 40 years in many cases. So you're going to see that all plans are not alike, that they're not all equal, and what we've done with the custom product is built enough flexibility in that plan to allow you to sort of push against these price increases that the companies have put on us. So the first thing we talk about, if you're going to pick a company in a limited playing field like we have, and I want to say that we represent all of them except for Transamerica, the carrier you choose really is the first thing you ought to consider. It usually isn't. Like I said, usually people go to price. But I think that the big difference is the carrier. You need to think about the size, their financial strength, their experience, their ability to meet their long-term obligations. Just in the last few weeks, some of you may know, the most dominant carrier in the market posted a $760 million third quarter loss. About half of that was an adjustment to their claims reserve. As a result, their stock plummeted, their S&P rating was downgraded, and they're in the process of looking at active life reserves, and there may be future adjustments. So I don't know where this company is going to end up. I don't know where any of these companies are going to end up, but I've been at this a while to have seen a whole lot of companies get in and out of this market, and some of them have bit the dust. And it may be that some of the remaining carriers will also bite the dust. I don't know. But what I do know is I think it's smart to pick the best rated product and the carrier that you think is most likely to be there over the long haul. So when we look at Mutual, it's the company and the product that you present has to hold up over the long haul. It remains to be seen, like I said, if any of them are going to be here in the future, but our belief is that Mutual stands the best chance. You can't go wrong compared with the competition with Mutual. The ratings, top to bottom, are the best. You compare them yourself. They're the best of anybody in the business right now. Their brand, for our demographic, the baby boomer, is just an awesome brand that's very recognizable, very favorably received. So what I want to do next is talk about products, because in a webinar it's a little bit odd. You can't see me, I can't see you. I don't know how many of you on the line today know about the product or have written the product. So I have to assume that maybe you don't know. So for those of you that don't know, Mutual of Omaha has two products. One is the secure product. The other is a custom product. The secure is sort of the traditional benefit period product with less features than the custom product. The custom product is something that AIM and our partners in Minneapolis, Golden Care USA, have had heavy influence on in terms of the design of the benefits and the features that we'll go through next. So that's the first thing I want to do, is just help you understand the differences between these two products. And what I've done is sort of pre-highlighted the areas. I'm going to move through this really quickly. You'll see that both plans can be written all the way up through 79. They're TQ. They're partnership qualified. The policy limits, the way they're set up, the secure product is, as I mentioned earlier, a benefit period product, whereas the custom product is a pool of money. But our feeling is what people are buying is financial protection. They're not buying protection for periods of time. So it's best to convey the value of the product you're selling in terms of what it's doing, which is providing money. The other area of differentiation here is on the elimination periods. With the custom plan, you can offer a 0, 30, or 60-day elimination period that's not available in the secure product. Here's the big one. With the custom product, you've got a 40% cash benefit. We used to be able to option that up to 50%, and I wish like heck we still had that, but in this generation of product, we had that on the United product, but we have the 40%, and the more cash you can get, the better. So this is a major difference between the custom and the secure product. In all other respects on this page, as you can see, the plans are the same. Both of them have options to scale the premium down on assisted living and home care by bringing the benefits down. And the stay-at-home benefits, adult daycare, bed reservation, those are all the same. A couple points here. Alternate care. A lot of plans, well, there was a time when no policies had alternate care. Then somebody, I believe it was CNA, maybe 20 years ago, put an alternate plan of care benefit in their policy, and very quickly all the companies raced to copy, and we were in a really heavy product development and a very competitive time in the market. This is a valuable benefit, and it's sort of disappeared. Most plans don't have them. The mutual product does. Another difference maker is the spouse security benefit. It's completely unique in the industry, and if you're not familiar with it, I'm not going to go through all these features in great detail right now, but I want to draw your attention to it. It's a really good benefit that can save a sale when you have one person who's insurable and a spouse who's not. You see that the joint waiver of premium, which is also very popular, is available as an option on the custom product, as is the survivorship benefit, and it's not on the secure product. Both plans have the waiver of home care elimination period, the non-forfeiture, the return of premium at death less claims, 3 times max. I don't know if you can see that there. This is actually a new benefit available on both plans, and we're getting more play on a return of premium benefit than we ever have before. We're marketing it as a little final expense product, and it's very affordable. The difference on the custom plan is it's got the full ROP, less claims, and it's also got a ROP at death, less claims if death occurs prior to age 65. Custom also has a benefit that we've actually been marketing with different companies over the course of maybe 20, 25 years, the professional home care benefit. Nobody else has this. It's a nice little kicker. We've busted it out as an option here, but it allows the policy to pay double benefits for professional care at home. It's just another way to sort of separate yourself from the competition. Inflation protection. This is something we spent a good deal of time working on, and these are our ideas. We know that price has become an issue, that the companies keep raising the rates over and over and over again, yet affordability hasn't changed much at all. And if you can't match the price with where affordability lives, you're not going to make a sale. Coming back to my first comments about the quote requests we get in here every day, we have people that they just haven't recognized that the world has changed, that they're asking us to quote 5% compound and the highest benefit periods, quotes that are coming in like $7,000. They're just not going to be sold. You may know or not know that the average premium right now on a Mutual of Omaha sale across thousands and thousands of policies is about $22.50 per individual. And what that tells you is, there's plenty of cases higher than that, and there's some cases lower than that, but that's the average. That's where affordability really lives. What's interesting is that in 1995, the average premium was about $17.50. So it's only moved about $500 in 20 years. Yet we know that the companies have dramatically raised the rates, much more than that $500. So something's got to give, and what has to give is the benefits. So we've done some things with inflation, and I'll show you this in a little bit. There's a lot of premium happens in this inflation area, so we've created some options. Basically, that's all they are, is places to go to find affordability. I want to transition here now and talk a little bit about some trends that have taken place in our business over the last while. After years of innovation and companies aggressively competing with each other, companies have actually been retrenching and taking really meaningful benefits away. We've seen the benefit periods lowered, the lifetime benefit first being priced out of sight and then pulled completely. And inflation rates have gone through the roof across the board. The stat at the bottom, 78% of adults receiving LTC at home rely exclusively on family and friends. What we're seeing is some of these benefits that are disappearing, like Hancock's private hire caregiver benefit is gone. Genworth's informal caregiver benefit is gone. Their alternate plan of care benefit is gone. MedAmerica's Simplicity full cash plan is gone. These are all benefits that allow people to take to be cared for at home, to stay at home. So I don't know what you guys are thinking. Does any of this really matter? We're all just trying to make sales here, right? These are just sort of bells and whistles that don't amount to much. But maybe that's not true. I would ask you to think about, why would the companies be getting rid of them if they didn't mean anything? I think the truth is these things do make a difference, and the products today are actually much more restrictive than the products of just a few years back. And where I'm going with all this is to try and emphasize for you why cash is so important in a product. With the custom product, you can get 40% of your monthly benefit paid in cash and use the money any way you want to. There's no receipts needed. You hit the ADL triggers or the cognitive trigger and you get paid. It's completely flexible. It never gets old. It changes with the time, which is so important. Most plans don't do that. We call it the new kind of long-term care insurance rather than the old kind. We have a very good friend of ours, Lenny Anderson, who owns Golden Care USA. They're our partners in the East. We market the Mutual of Omaha in the West, and they market it in the East. And we've been together all the way back in the Aegon days for 30 years or so. Lenny likes to say that if your plan doesn't have cash, it isn't long-term care. Now, that may be a little bit strong, but he's on to something really important. Like I mentioned, Lenny's, Lenny's maybe in his 70s now, and he's been at it a while, and I have too. I've been at it since the 80s, long enough to have witnessed the entire evolution of long-term care insurance. So why don't most plans adapt, and what do we mean by static definition-based policies? What we mean by that is policies are written around the current long-term care delivery system, whatever that happens to be at the time. Some of you may remember that LTC policies haven't always covered home health care, or that they covered home health care before assisted living. What's interesting in the case of assisted living is not that the policies didn't cover it, it's why. And the reason why is assisted living didn't even exist. That's the point I'm trying to make. Things change. What insurance companies do, in effect, is take a snapshot of the current healthcare environment and write an insurance contract with definitions, very specific definitions around that, around what they already know exists today. They try and pin it down. Most carriers, even though ALF didn't exist, actually found that their definitions of nursing home were written loosely enough that arguably they did cover them. It's created a lot of arguments, quite frankly, messy claims disputes, arguments about whether or not the place one's loved one is receiving care is a nursing home or an assisted living facility. It's actually spawned, maybe in part, a new industry. There's a company out there that was started by a good friend of ours, an agent, called Claims Jockey. And what they do is work with claimants, helping them to get their benefits. And in some cases, it's getting in the middle of policy definitions. So as consumers demanded different kinds of services like home health care and assisted living, and the delivery system evolved around that, carriers have sort of been pulled along to create products that address the changes, the new healthcare environment. Since these plans are only as good as the definitions in the contract, the question is, what services will emerge in the future, and will the policy cover them? In this rapidly changing world, do we expect the policies we're selling today to become less obsolete than those in the past? I think without cash, the answer is no, they're going to be just as obsolete. In fact, as I'm about to show you, most plans are at least partially obsolete already when it comes to long-term care services. This is something I have a little bit of fun just to kind of illustrate the point. I'd say it's been at least 20 years or so that Amex first came out with an innovative new benefit called the Medical Alert System benefit. And as was the case back then, when anybody did something innovative and new, very quickly every company in the industry added a Medical Alert System benefit. As far as I know, they all still have them. They're very specific about what a Medical Alert System is and is not. If you look at that little cutout over here, it's a little phone jack. I think our kids probably wouldn't even recognize what that thing is right now, and I suspect it isn't long for this world. So having the old Medical Alert System is great, but there's already a host of other home monitoring devices, cameras, wearable smart sensors, and wireless Netflix systems, making virtual medicine today's reality. Family and care providers can keep real tabs on people now remotely and intervene when necessary. They're able to actually keep tabs on people remotely. Care assessment and treatment in many cases can now be done cost-effectively and remotely. Blood, urine, and drug concentrations can be monitored. Daily measures of body weight and blood pressures can be recorded via sensors. The data transmitted wirelessly. There's video conferencing with patients and physicians, motion sensors to monitor a person's presence in a room and movement patterns looking for unusual behavior. There's electronic pill boxes to remind patients when to take medications and make inquiries about measures like blood glucose levels, side effects, or general well-being. All of these things and more, they're here now. And so the question is, how will the typical LTC product pay for these types of devices and services, let alone future healthcare developments, 10, 20, 30, 40 years from now? The answer is not very well, not if they don't have cash. But what I'd like you guys to remember is that cash is really, really important. More important, I think, than a lot of the people we talk to. They just aren't really paying attention. Just remember, it's uniquely flexible, it's all-inclusive, and most importantly, it's timeless. Hit the policy benefit triggers. They're the same as any TQ policy. You get paid from the very first day of disability. End of story. You spend the money any way you want to, any way you see fit. What this is about control, and you know, it's about putting the patient in control rather than the insurance company. If you remember looking back at that medical alert system definition, that's all about company control. So just to hammer the point of the future is sort of here right now, I'm going to let a couple of short videos do the talking for me and take a break and show you a little bit about what's taking place in the housing options for seniors. Remember I told you about assisted living not existing before, or even home care for the most part. This will show you that it's happening again, and what we all need to think about is that it's going to continue to happen in the future. So bear with me here, and I'll see if I can pop this video up.
RP says about 23 million Americans take care of their elderly parents. Many have to choose between letting their parents live alone or moving them into a nursing home.
As Wyatt Andrews reports, there's now another option that brings families closer, even when they're not living under the same roof.
When Viola Baez began to need constant care last winter, her daughter, Sacarito Page, would not even consider moving her to a nursing home. Viola had told everyone for years, no nursing homes, not ever.
Whenever we had to visit somebody who was in a nursing home, or we drove past one, I don't want to be in a place like that. You know, so.
A very clear instruction.
Very clear. Very, very clear.
Paige wanted her mother to live close by and wanted her to have independence. So she bought this portable apartment called a med cottage. She put the cottage in the yard, right outside the kitchen window, and built a 20-foot walkway so Viola can come and go at will.
It's her space, but it's still with us.
Right out the back door.
Mm-hmm.
The med cottage is basically a 3-room apartment equipped like a hospital room. There are safety rails, lighted floorboards, and a wall with a first aid kit and defibrillator machine. The structure also comes with 3 built-in cameras, including one that's here in the ceiling overlooking the kitchen, and then this one. This camera is mounted in the floor and is designed to alert the family in the event that Viola falls. Ken Dupin, who founded the company, says Med Cottage is the formal name for his product, but it's not what most people call it.
Granny Pod? Initially, Granny Pod was your first name? Well, that wasn't our name. You don't get to choose your nickname.
Whatever the name, Dupin believes he's found an answer for millions of baby boomers who are facing both their own retirements and the need to care for their parents.
And we wanted to say there's got to be a better way to do this, particularly as it involves family. And we feel that this is a very American solution.
The solution can be expensive. This cottage is $125,000. But Paige figured that a nursing home would cost more than $60,000 a year and take Viola where she didn't want to be.
Viola, what do you think? What do you think of this house?
As long as I live with my family, it's okay.
For Viola, the cottage outside the window represents the safety and care she always wanted. But for millions of other Americans, it's a possible glimpse of the future. For CBS This Morning, Wyatt Andrews, Alexandria, Virginia.
Tough choices for people.
Very tough choices. The list is at least a...
Okay, I'm going to show you one more. It's similar, but it's different, and it'll talk a little bit about the alternatives for funding something like this. They mentioned $125,000. I'm thinking that you can probably get a mortgage on something like that, and you can probably sell it as well. So bear with me. Here's one more video for you.
That is inevitable. Your mother, father, or other elderly loved one can no longer safely live independently. So what's the answer? The anguish, anxiety, and uncertainty of an assisted living facility? The stress of mom or dad moving in with you? A costly addition to your house? All are challenging scenarios. There is a new option. It's called Echo Cottages, and it will revolutionize the way we will care for our loved ones in their time of need. ECHO stands for Elder Cottage Housing Opportunity. This is a new concept mastered by Echo Cottages Ltd. We are a Hudson Valley, New York-based family-owned company that has been building custom homes for 3 generations. On paper, an Echo Cottage is a temporary house discreetly placed on a homeowner's property, specifically designed for the needs of its elderly occupants. When living requirements change, the Echo Cottage is removed. In reality, though, our Echo Cottages are so much more.
Okay, I'm going to jump ahead here. They're going to go through about a minute worth of amenities and things like that. So fast forward here.
The host family if the occupant does not get up by a certain time. Panic buttons and other safety features are all available. An Echo Cottage allows your loved one to maintain a safe amount of independence, privacy, and dignity. They can set heat and AC to their desired level, turn the TV as loud as needed, and keep their beloved pets right with them where they belong. Instead of having to travel far to pick up mom or dad for the doctor or shopping, mom or dad is only steps away. If grandchildren want to visit, grandma or grandpa is right there. Studies have shown that seniors who interact with family live longer, healthier, and happier lives. Here's how it works. Our Echo Cottages are built on a proprietary mobile sub-assembly, allowing for an incredibly sturdy structure that can be wheeled onto your property. Once in place, the entire cottage is skirted and the underassembly is completely hidden from view. Best of all, you do not have to buy our Echo Cottages to have the peace of mind that comes with providing this high level of care for your loved ones. Our Echo Cottages are all leased on a month-to-month basis. We set the unit up when ordered and remove it when living requirements change. You don't have to worry about what to do with it when you no longer need it. It's that simple. From our family to yours, we understand the importance of senior care and have developed.
Okay, let me pop out of here. And get back into the presentation here. So what I'm trying to do here is, rather than have you read things about cash and you know, trying to think about what it might do for people, is to show examples of what's going on right now. These are things that are happening right now, and it's a very, very rapidly changing world. What I know for sure is that cash can be used to pay for these things, and I know for sure that a static definition-based policy absolutely will not pay for those things. That's really, really important. Coming back to that 78% stat, you know, I've often wondered, you know, embedded in that number is 78% of the care is provided by informal caregivers. Some of that is because they don't have insurance and they have no alternatives. But I think what these videos also show is that people want to care for their loved ones. They want to stay close to them. They don't want to institutionalize them. So that we will continue to see innovation in technology and housing. And I think that if you had to choose between a plan that gave you flexibility and one that didn't, at relatively similar costs, you know, for sure, if it were me, I'd make sure I had a cash benefit. I have a policy, and it doesn't have a cash benefit because I bought it 14 years ago. But I really wish it did. I really do. So a couple other things to think about here. One of them is the, you know, elongated time periods policies must remain relevant. We should also think about how much longer policies today, you know, how much longer they need to last today as compared to the past in terms of, you know, in terms of innovation and development. What I'm trying to say, and I'm not saying it very good, is 20 years ago, the average age of an LTC applicant was 72 years old. Today it's 56 or so. For group, somewhere in the low 40s. So think also about longevity. People are living longer. Both morbidity and mortality are being pushed out to older ages. So the policy you sell today must remain relevant for 30, 40, or even 50 years from now, maybe even more in some cases. So how will the policy you're selling today measure up in a world that we can't even contemplate? Quickening, there's also this notion that not only are things going to continue to change, the rate of change is actually accelerated throughout history, and I think all of us are witness to that every day. I mean, it's just hard to keep up with how things are changing. There's so much going on, that's actually been going on, for a while. I can't keep up. I know that. So in terms of, I think, the potential for care, especially care at home, I think the potential is absolutely awesome. Another thought is the availability of services in rural areas. This is another area to think about with cash. I don't know if any of you have ever had a client who needed home care services in rural areas, but the services were not available. We hear about it all the time. We work with a couple of large agencies where they sell a ton of insurance in rural areas, and availability of services is a problem. Family, neighbors, or friends step in when informal care services are not available. People hang on for as long as possible at home. So I think that the cash, it covers all, and it opens up, a myriad of possibilities for people to stay at home, which is really, really important. So, okay, that's enough about cash. What I'm hoping to do, hoping that I have done, is left a little bit of a mark on you. Be sure to think about cash, and when you talk to your clients about cash, you'll find that they're very, very responsive to it. When you talk about the new kind of long-term care insurance versus the old in a competitive situation and tell them what cash can do, you're going to find people that respond to you. Transitioning to inflation benefits and being able to basically find that price point, because if you can't find a price where people can comfortably afford it, you're not going to make the sale. So this slide is showing a 45-year-old, 55-year-old, and 65-year-old couple with a $4,500 per month benefit, $175,000 total benefits with 5% compound. There's a couple things to notice. One is the high percentage of the total premium that's going to pay for the inflation protection. Two, it shows the percentage of premium for inflation protection is higher the younger you are. So if something has to give to get the rates down to where people can afford coverage, inflation is where it needs to happen, or it's one of the very best ways, I'll say it that way. So I know a lot of you, we've already mostly been forced off the 5%. So this slide, I basically just kept the benefits the same and moved the inflation option from 5% down to 3%. The percentage of premium that the inflation benefit represents predictably came down a little bit, but there's still a ton of premium there. And this is where we decided when we put the custom product together, we had to do some things to give agents some options to find that price point where people can afford the coverage. So what we did is we added a 1% and a 2% option. Nobody else has it. We've done a lot of this in the past, come out with things that nobody else has. In fact, the 3 and the 4, I think, was our original invention. And people are slow to move to anything new. But again, I think knowing where average premiums are and knowing what the companies are doing, we knew that we had to provide additional options for agents. And it's a kind of a funny thing. I remember when we sold long-term care insurance without inflation protection, and we sold a ton of it. And the reason we sold it without inflation protection is because it wasn't available. Nobody had thought of it yet. And when they did think of it, they thought of 5%, and after a while, 5% was the only thing people could sell, and they thought they were doing somebody a disservice to sell something less. We don't think that anymore. We think that any plan is a good plan. That if circumstances dictate that you need to sell a 1% option, that's absolutely a good sale. The other thing we did is we added increments. And once again, this is something that the industry has not seen before. But again, it's something it's done with a reason. We know that on average, a quarter-point move in premium is about 6% in premium. On an average couple sale, that can be about $300. I'll show you some of this, show you some rates here in a little bit. But you know, $300 moves on a couple at a quarter point, that's worth doing. That's a lot of premium. We used to, when we used to consider offering riders various things, if it was something, you know, less than 10%, it became debatable as to whether or not it was worth putting out there. But now that the premiums are so high, when you translate that into real dollars, you know, it's just a good option to have, and we're starting to see a lot of people start to use these lower increments. The last thing we did is we used to have the 20-year cap on inflation. Of course, you can have, you know, unlimited inflation where benefits increase every year forever. But a great way to get the price down is to put a cap on it. So we had the 20-year cap, and we've added additional caps, a 15-year cap and a 10-year cap. And depending on the age and again, the circumstances, it can be a really, really good way to manage premium. Get it to a point where people can afford it and are comfortable, where you make a sale. When we did this, we convinced Mutual that that for them, selling less inflation is in their best interest, and we understood that we were going against the grain in terms of just convention, where agents had been trained to sell 5%. And we know that, you know, going against convention, when you have kids involved and agents worried about kids saying they didn't sell enough, the agent didn't sell enough coverage and so forth, we thought the thing to do to make this go would be to take the agent off the hook. And the way to take the agent off the hook is allow the client to make a new decision to add more inflation later. So the guaranteed buy-up option is again totally unique. For any inflation option less than 5% compound, you can add inflation every year without evidence of insurability, so long as you haven't been on claim. So for example, if you sold somebody a 2% option, they have the ability every year to add to that, not to exceed 5 total. The offer expires in the earlier of 20 years or age 75. So this is really a great way for you to go in if the sales circumstances dictate that 2 is what needs to be sold, or 2 of the 20-year cap. Your clients have the option to increase that every single year. So this is just an example showing that what these lower options will do. I'll talk a little bit about the 1%. So let's say we sold a $150,000 plan. In 30 years, you can say that that plan went up by a third to over $200,000. By all means, guys, what I'm not trying to say you should sell 1% when you can sell 5 or 4 or 3 or whatever. What I'm saying is, to make sales, you need to find that price that people can afford. And to me, there's absolutely no shame in selling that 1% option. It's really a great option. This is just a chart that shows. I picked a 55-year-old couple, $4,500, same plan configuration, $175,000, 90 days, and the 3% option. Basically, this slide shows the complete range of premium you could sell to this individual, for this benefit configuration, and the different configuration for inflation options. So you can go all the way to $6,200 or all the way down to $1,697. But check this out: if you go from 3% option and drop it down to 2 3/4, you're knocking $159 off that to $32.38. If you move it over here to the 20-year cap, you're knocking another $524 of premium out of that for a total savings of $683. That's that's real money, and that can be the difference between making a sale and not making a sale. So we're coming up on 45 minutes, which is about the end. What I was going to do is take you into the software, but I think I won't do that. If you haven't looked at the software, it was developed by our very own Dale Moore here in the office. He's the son of an LTC agent. He's a child prodigy computer geek. I say that with love. He's built many, many long-term care quoting software tools. Ours is considered the best out there. A lot of agents will actually stick it in front of their clients and let their clients play with it and basically build their own plan. If you don't have that downloaded, you can download it from our website at www.yaim.com/software. If you want it sent to you, we'd be happy to send it to you. So wrapping up before turning it back over to Dave and opening it up for questions, I wanted to say just a couple things. It's no longer LTC Awareness Month, but we like to say around here that every month is LTC Awareness Month. It's kind of funny, when you have like a fire sale, when a company has a new product coming, all of a sudden it's LTC Awareness Month, where agents go crazy and they just start making sales. And the reason they start making sales is because they open their mouths and start talking about it. There's lots of material we have around here to just get the conversation started. And maybe this is a good time to start planning next year. A conversation up, you're going to make sales, and we'd love to help you make that. Remind you that with the mutual product, there is a 5% producer discount. Consider the premium from your own commissions that you receive, plus the additional 5% producer discount. Here, if you guys aren't familiar with it yet or writing it, product that'll give you a place to go.
Yeah, I'm sorry, John. Somebody has us on a speakerphone and it's got some noise in the background. It's kind of cutting you out.
Yeah, I can hear it. I'm trying to just plow through it. So GTL Critical Care and United Security, those are really great substandard options for you guys. Also, I have seen a lot of thing from us lately on the products, critical illness products, and heart, stroke, cancer products. We've got a really great new product from Mutual of Omaha, their heart, stroke, cancer. Almost a guaranteed issue cancer product that's interested in. Just shoot us a note or pick up the phone, and we'd love to talk to you about it. With that, Dave, I'll turn it back over to you, and you can open it up.
Hey, thanks, John. I do have the phone lines wide open. Just a couple of little thoughts came to mind while John was talking. If you are using our online quoting tool on our website and you're quoting custom, it limits you to only $25,000 increments on the policy limit. So that's another reason why you should actually download or let us send you the CD for the standalone software that allows you to dial that increment down to a $500 level. And then when John was talking about inflation, partnership is a big word or a big deal out there nowadays as far as getting the asset protection out of your long-term care policy. And the saying around here in our office is one is better than none. So if your client is really balking at the idea of inflation, take a serious look at just putting the 1% option on there. As long as they get at least 1%, now they're in the game. And once they're in the game, they can bump that number up. In a lot of states, 1% is approved for partnership. And then in other states where the minimum is 3%, you can actually buy up into partnership. So if you start off at less than 3, you can buy into 3%. And once you've done that, you now have a partnership compliant policy. But John, thanks. Those are all great thoughts. I'd like to open it up. If anybody else out there has a question of myself or John, fire away.
Dave, Dennis from Paula here.
Yeah, Dennis.
Are you going to send that CD out to everybody on the phone, or by request only?
For the software?
Yeah.
So your best bet, Dennis, is to download it. Like we can but I'll be happy to, since you asked for it. I will send you the CD.
Okay, I thought you said there was an option that we couldn't get on the on your website. That was only available on the...
No, if you're doing the online quoting, using the online quoting tool on our website where you can spreadsheet people across different carriers, that has the limitation of the $25,000 policy limit on the custom.
Yes.
It's not our fault. It's not our software.
Yeah.
but I'd be happy to send you the CD, and I'll make a note to send you the CD of the standalone version of the software.
Thank you, Dave.
And remember, once again, I made the little commercial at the very beginning of the webinar. In this week's Mutual Express, if you are already appointed with Mutual, you should be receiving their weekly email newsletter. But if you haven't, they have compiled a nice, brief, less than 2-minute long video with Kiplinger, a very generic presentation on why someone should consider buying long-term care. It could be something you might want to consider adding to your email signature for people to click on to learn more about long-term care. Really brief, very succinct, well done. So you can either call me at 800-672-7202 or pop me an email, or John. My email is dave.whelan, spelled W-H-E-L-A-N, at whyaim.com. Or John is john.hennessy, Hennessey, at yaim.com, and we'll get that video, a link to the video sent out to you right away.
Hello.
Any other questions?
Hello, can you hear me?
Yes.
Oh, hi, this is Christopher calling in from California. I got in a little late on the webinar. I think I got almost 75% of it. But the name of this insurance company is called Mutual Express.
Mutual of Omaha is the
Oh,
carrier.
it's Mutual of Omaha. Okay, is this product available in California?
We're thinking we'll be back in California in February.
Okay, I appreciate it. You guys did an outstanding job. Thank you for being there.
Thank you, Christopher.
Question about durable medical equipment and some of the new monitoring devices. Many of the policies that I'm seeing right now that I'm using on claim do have a note for using durable medical equipment. Can we not use some of those more high-tech medication delivery and video things under that durable medical equipment clause?
You certainly can. With Mutual, the DME benefit is part of a lump of benefits of caregiver training, home modifications. It's equal to 2 times whatever your monthly home health care benefit is.
And can be done before claim, too.
Right. So if you want to tap into that benefit to help pay for some of these advanced devices, that you can do that. But that's a limited benefit where the cash will keep on paying on a monthly benefit forever, or at least for as long as your policy is in force. So it's just
the monitoring fees and stuff.
Right. It's the way to extend the DME benefit.
Okay. Perfect. Thank you.
Good question, though. Thank you. Any other questions?
Yeah, this is Mary Reagan in California. Now, this United Security, I've never heard of it, but they take difficult cases for long-term care. Is that right?
Yeah, they're not in every state, so it's kind of a case-by-case basis. It is a high-risk type offering, but I'm not sure if they're up in California. I can check on it for you, Mary, and follow up with you after the webinar.
Yeah, I don't believe they are, but we will check. Yeah.
And you said Mutual of Omaha will be coming in February?
Yeah, we tried to come in October, but we hit a little bump with the insurance commissioner's office, and now they just about have that rectified, and we're targeting right about mid-February.
So can we still get material on it? Or, I mean, will it be different in California? Oh.
It's going to be very similar to the product outside of California. I don't think there's hardly any difference at all. So if you're familiar with the material outside of California, it'll be a natural fit for you when it does roll into California.
Okay, thank you.
You're welcome.
John, this is Dennis again. I just wanted to thank you for the program. It was nice going down memory lane here and putting things, putting our life in context and having a window open to what the future bears. Because I'm not going anywhere. So.
Yeah. Appreciate that, Dennis. Yeah.
Oh, thank you. Oh, I have one more question. How do I get a copy of the Kiplinger piece?
The video?
Oh, it's not a piece of paper that I can show
we do have pieces of paper that were articles in Kiplinger or advertisements in Kiplinger that we have hard copy here of. The one I mentioned on the webinar today was that, they've actually put together a real brief little 2-minute YouTube video in conjunction with Mutual of Omaha, but it is very generic. The only branding on the video itself is Kiplinger's name themselves.
There is another piece that was in the, I believe it's this December Kiplinger magazine that we have copies of. So just shoot either myself or Dave a note, and we can get you a supply of those. It's actually a really handsome consumer piece, and it's a good conversation starter.
And how do I write you, or?
Shoot us an email.
Or call us. Our number here is 800-672-7202. We're always willing to talk with you on the phone as well.
02. Okay. All right. Thank you.
All right, John, thanks again for taking the time this morning. Thank you, everybody, for taking your time out of your valuable day to join with us this morning. We'll look forward to hooking up with you again shortly. Keep an eye on our website for the upcoming webinars, and have a great weekend, everyone.
So long, Dave.
Bye.